Warren Buffett's investment strategy is not a secret. He has explained it publicly, in plain language, for over 60 years. Buy good businesses. Hold them. Don't panic. Wait. Millions of people know this. Almost none of them can do it. That gap is not an information problem. It's a psychological one. And Buffett has spent 60 years solving it. That solution is worth more than the strategy itself. In 2020, the S&P 500 dropped 34% in 33 days. It was the fastest crash in market history. During those 33 days, U.S. retail investors sold $30 billion in equity funds. They locked in the loss. Then the market recovered fully within 5 months. Those investors knew the rule: buy and hold. Don't panic, sell. They knew it, and they sold anyway. Buffett bought during that window. He bought Occidental Petroleum at a discount. He bought with calm. The difference was not information. Both groups had the same data. The difference was psychological architecture, a specific set of mental structures that Buffett has deliberately built and publicly documented. Today we're going to reverse engineer those structures. Buffett has said the same thing in different words for decades. In 1987, he wrote in his annual letter to shareholders, "Success in investing doesn't correlate with IQ. What you need is the temperament to control urges that get other people into trouble." That word, temperament, is doing serious work. In psychology, temperament refers to stable, biologically grounded patterns of emotional reactivity and self-regulation. It is distinct from intelligence, knowledge, or skill. It is closer to what psychologists call emotional regulation, the capacity to experience a strong emotional signal and not immediately act on it. Neuroscience has a framework for what Buffett is describing. The dual process model, formalized by Daniel Kahneman, distinguishes between System 1 thinking, which is fast, emotional, and automatic, and System 2 thinking, which is slow, deliberate, and effortful. A 34% portfolio drop in 33 days is a maximum intensity System 1 trigger. Your amygdala, the brain's threat detection center, registers financial loss identically to physical danger. Cortisol rises, tunnel vision narrows, action feels urgent and necessary. Buffett's documented behavior during crash is not bravery. It is a trained system to override of a System 1 alarm. The distinction matters because bravery implies the fear isn't real. Buffett's fear is real. What's different is what he does with it. That is a trainable skill, and everything that follows explains how he trained it. Here's what nobody tells you about Buffett's actual strategy. The primary action in his portfolio is not buying. It is not selling. It is not acting for years at a time. Buffett has held Coca-Cola stock since 1988. That is 36 years of market crash, recessions, geopolitical crises, pandemics, and interest rate cycles. 36 years of financial media telling investors to reposition. His return on Coca-Cola, over 1,700%. The psychological barrier to that outcome is not finding Coca-Cola. It is surviving the psychological pressure to do something across 36 years of manufactured urgency. In 2000, psychologists Brad Barber and Terence Odian published a study of 66,400 household brokerage accounts. Between 1991 and 1996, their finding, the accounts that traded most underperformed the accounts that traded least by 6.5 percentage points annually. The most active investors, the ones doing the most, earned the least. They named the cause overconfidence bias, the belief that one's judgment is reliable enough to justify frequent repositioning. But the deeper mechanism was action bias, the psychological tendency to prefer doing something over doing nothing, even when inaction is the demonstrably correct choice. In sports psychology, action bias is well documented in penalty kicks. Goalkeepers dive 94% of the time, even though staying in the center blocks the most goals statistically. Diving feels like responding. Standing still feels like failing. Your portfolio is a penalty kick, and your brain is demanding you dive. Buffett stands in the center. In October 2008, at the precise depth of the global financial crisis, Warren Buffett published an op-ed in the New York Times. The headline, by American. The Dow Jones had fallen 40% from its peak. Banks were failing. Unemployment was spiking. Every financial indicator was deteriorating in real time. And Buffett was publicly, enthusiastically buying. This is not contrarianism for its own sake. It is a specific cognitive reframe that Buffett has described repeatedly and precisely. He calls it thinking about Mr. Market, a concept he inherited from his mentor Benjamin Graham. Graham's original framework, published in 1949 in The Intelligent Investor, proposed imagining the stock market as a business partner, Mr. Market, who shows up every day offering to buy your shares or sell you his. Some days Mr. Market is euphoric and offers absurdly high prices. Some days he's terrified and offers absurdly low ones. The key insight: Mr. Market's emotional state is irrelevant to the actual value of the underlying business. In psychological terms, Graham was teaching cognitive diffusion, a technique from acceptance and commitment therapy in which you observe your thoughts and emotional signals without treating them as commands. When the market drops 34%, the signal your brain receives is danger, sell, survive. Buffett's reframe converts that signal into Mr. Market is scared. He's offering me a discount. Same data. Completely different behavioral output. The reframe is the skill. Buffett's psychological edge is not just cognitive, it's structural. He has deliberately constructed an identity and an environment that make panic selling nearly impossible. Consider the specifics. He has lived in the same house since 1958. He eats the same breakfast most mornings. He reads for 5 to 6 hours daily. He does not use a computer for financial modeling. He does not attend most corporate social events. He limits decisions to a small number of high-quality choices per day. This is not eccentricity. This is decision fatigue management, a documented psychological phenomenon in which the quality of decisions deteriorates as the number of decisions made in a day increases. In 2011, Jonathan Leviv at Stanford and Shai Danziger at Ben-Gurion University analyzed 1,112 parole board decisions over 10 months. Prisoners appearing early in the session received parole 65% of the time. Prisoners appearing late received it almost 0% of the time. The board members were not more lenient in the morning by personality. They were simply less depleted. Decision quality fell with decision volume. Buffett's lifestyle is a decision conservation strategy. By minimizing trivial choices, he preserves cognitive capacity for the moments when markets offer genuine decisions. Here's what nobody tells you about his wealth. The environment he built is as important as the philosophy he holds. Most investors have the philosophy. Almost none of them build the environment. Let's be precise about what this means for markets today. In 1965, when Buffett took control of Berkshire Hathaway, institutional investors held roughly 16% of U.S. equities. Individual investors held the rest. By 2024, institutional investors hold over 80%. These are hedge funds, algorithmic trading systems, and professional analysts with real-time data and computational resources no individual can replicate. The informational edge that Buffett used to find undervalued companies in the 1960s is structurally unavailable to most investors today. But the psychological edge has become more valuable, not less. Because algorithmic systems are explicitly designed to exploit short-term price movements and behavioral patterns, they profit from your panic selling. They profit from your overtrading. They profit from your action bias. The one thing a 300 millisecond trading algorithm cannot do is hold a position for 20 years because it understands the fundamental value of the underlying business. That requires a human judgment about the future. And it requires the psychological infrastructure to hold that judgment when Mr. Market is screaming. In 2022, researcher Hendrik Bessembinder at Arizona State University published an analysis of 64,000 global stocks. From 1990 to 2020, his finding: just 2.4% of stocks accounted for all net global wealth creation. The other 97.6% collectively matched the return of treasury bills. The implication is specific. Selling a position in a genuinely exceptional business to reduce short-term anxiety carries a catastrophic long-term cost. Not because you lose money on the sale, because you lose the position. And the psychological capacity to identify and hold the 2.4% across years of volatility, doubt, and media noise, that is the rarest edge in modern investing. Buffett did not find a strategy others missed. He built a mind others couldn't maintain. You are not Warren Buffett. You don't need to be. But there are 3 specific psychological practices that Buffett has documented, that research supports, and that you can implement without his net worth. First, Convert price drops into a reframe, not a response. Before you see your portfolio during a market correction, write one sentence, one that explains why you bought each position you hold. Not what it's worth today, why you bought it. Then, when the drop comes, read that sentence first. You are not consulting the past. You are activating System 2 before System 1 takes control. That 30-second practice is the retail version of Mr. Market. Second, make your investment decisions boring. Set a recurring automatic investment, one index fund or a small number of high-conviction positions. Remove alerts from your brokerage app. Check your portfolio quarterly, not daily. Barber and audience data is not ambiguous. The more you look, the more you trade. The more you trade, the worse you do. Boredom is not a failure of engagement. It is evidence that your system is working. Third, audit your information environment. Buffett reads annual reports and business histories. He does not watch financial television. This is not a posture. It is a calibration of signal-to-noise ratio. Financial media optimizes for urgency and emotional engagement, not for decision quality. Every piece of content that makes your portfolio feel urgent is a piece of content that increases the probability of an action bias error. Your information diet is your decision environment. Treat it like one. Here's the one-sentence summary. Buffett's returns came from strategy, but his strategy survived because of the psychological architecture he built around it. The architecture is not secret. It is documented in 60 years of letters, interviews, and shareholder meetings. The only question is whether you will build it. If this changed how you think about investing psychology, subscribe. Every week on this channel, we go deeper into the psychology behind every financial decision you make.